Okay, in this video, I am going to cover natural resources and intangible assets. I'm going to try to pound both of them out here, hopefully within 10, 15 minutes. I'll start with natural resources. Um, Natural resources are essentially, things like oil, coal, gold. We're going to acquire a bunch of land, and in that land, there will be natural resources such as oil, coal, or gold. And we're going to go in and usually we're going to extract those natural resources and then put them on the open market for sale, right or wrong. Anyway, it's a lot of the concepts in this section are very similar to all the discussions that we had about the physical long-term assets like machinery, plant, and equipment. The only real differences are that when we deal with natural resources, we're only going to use one depreciation method, and we use the depreciation method that's essentially units of production. Okay. And then as we calculate um, the decline in the natural resources reserves, we're not going to refer to it as depreciation expense. Instead, we're going to refer to it as depletion expense. So units of production and its depletion expense, not depreciation. Okay? So let's look at an example. A mineral deposit with an estimated 250,000 tons of available ore is purchased for 500,000. We expect zero salvage value. The depletion charge is $2 per ton, right? And we're getting $2 per ton by, again, using the units of production method, right? So it's cost minus the salvage value divided by all of the anticipated use over the life of this natural resource. And so we're talking about units of capacity. Okay, so, in our examples previously, it was machine hours. If it was a car, it would be number of miles driven. But since this is a natural resource, it's going to be tons of ore that we're going to anticipate pulling out of the ground. So we would take the $500,000 purchase price as the cost, and then we're going to assume no salvage value. As soon as we pull the last ore or the last ton of ore out of the ground, this thing is not going to be worth a penny. And then we're anticipating pulling out 250,000 tons. So 500,000 divided by 250,000 tons is $2 per ton. Okay. And then the question is asking us to assume that in the first year, 85 tons are mined and sold. The depletion charge would be 170,000. And again, it's 85,000 tons times the $2 in depreciation charges per ton for a total of 170,000. And then the journal entry is just going to be, remember, depletion expense, not depreciation, but instead it's depletion. And then accumulated depletion mineral deposit. And we're just being specific about what the exact natural resource is. Okay. And then it's going to show up on the balance sheet as follows. Again, it'll be listed at cost, just like all of our other long-term assets. And then just under cost, we're going to include accumulated depletion. And in this example so far, it's 170. So the net book value of our natural resource at the end of the first year, $330,000. And all they're doing here is saying, hey, you know what? You can report it on the balance sheet net of cost. But anyway, that's natural resources. This slide is basically saying if we have a natural resource, like if we're pulling ore out of the ground and we need some heavy tractors, the heavy tractors would be included as machinery and equipment, not part of the natural resource. And then we would just depreciate those machines based on their useful life. And we could use straight line units of production or double declining balance. Okay, moving on to intangible assets. Learning objective P4, intangible assets. So intangible assets, they're non-current without physical substance, meaning they're all things that we can't necessarily see or feel. All right, but it's things like music, works of art, and so forth. Actually, it's like we can't touch it, but it's like a copyright or a song or an idea that's been patented. Okay. Often these intellectual or intangible assets have either a limited life or an exclusive right over the long haul, right? An indefinite amount of time. They're usually acquired for operational use, right? So we need to acquire them for protection, either against our competitors or new competitors. Let's keep going. Let's try just one more. Right, so all of our intangible assets, the most common intangible assets are definitely patents. Those are going to cover ideas like technology and cell phones or computers. We can do copyrights, which are going to protect like written works like songs and books, right? We can have franchises and licensees, right? So McDonald's, Burger King, if you wanted to own a McDonald's, you could just go license the name McDonald's and then you could use all of their branding and you got to make their food the right way. But you can purchase the right to use or distribute Big Macs if you wanted to. Trademarks and trade names, right? So these are things that have like Coke is a good trademark. It's probably one of the most common trademarks on the face of the earth. Goodwill is something that I do cover a lot in other classes, but goodwill is the amount by which somebody would purchase your business over and above the physical value of the business, right? So if you had a restaurant and the restaurant had, $200,000 worth of physical assets like the tables, the chairs, the refrigerator, the stove, all the stuff associated with the business. But then somebody came along and was willing to pay 300,000 for that business. The difference between the purchase price and all the value of all the physical, tangible assets, that $100,000, if you can't identify the intangible asset, right, like copyrights or franchises or patents or trademarks, then you would lump that $100,000 as goodwill. And it's all the value of all the intangibles that you just don't really know what they are. Okay. And then leasehold improvements, we talked about it actually at the very beginning of this chapter, where we could add value to a building that we're leasing, or we can improve land and so forth. Kind of gone through this, gone through this, gone through this. Okay, well, that was the end of that. And they pretty much don't tell you the most important part, which is, let's just talk about, we're not talking about research and development. So in essence, this slide is saying if we do conduct any research and development in our business, we just treat that as a cost in the particular period that we incur it. Okay. But let's say that we have a patent and the patent is worth $100,000, or we paid $100,000 for this patent. Actually, you know what? Let's say we paid $100,000 for some leasehold improvements. And we're thinking that these leasehold improvements are going to be useful for 10 years, 10 years, and they're going to have no salvage value. And we're going to use the straight line depreciation method. However, when I'm talking about the decline in a intangible asset, we don't use the word depreciation. We don't use the word depletion. When we're talking about intangible assets, we use the word amortization, right? Scary world we live in if I'm the one trying to teach you how to spell something, but there we go. Okay, so amortization. So again, if I purchased or if I paid $100,000 for a bunch of improvements to my existing office space, and it's going to be good for 10 years with no salvage value, the amortization expense every year would be, again, we're going to use straight line, so it's 100,000 minus no salvage value divided by 10 years. So my amortization expense every year, 10,000. So we would amortization expense 10,000 and accumulated amortization 10,000. And there we go.